What if you could use one simple strategy to add $100,000 or more to your wealth? Think about it like adding a turbocharger to your financial engine, fueling growth without using any extra resources. Today, my friends, we're going to be breaking down how the wealthy and savvy business owners and investors use S corporations to save massively on taxes, to build wealth, and to protect their assets. By the end of this video, you're going to have a blueprint to leverage the S Corp framework for serious wealth building. Now, my friends, if you're not a business owner, don't skip this, because if you're using the passive income machine, which is a combination of life insurance and real estate, to achieve financial freedom in 10 years or less, then you're setting up a business structure with your investments. And this structure allows you to fully harness the S Corp framework. So if you're serious about building wealth, mastering the S Corp strategy is a must. So let's dive in. Now, my friends, my name is Ryan Lee, and today I'm going to be unlocking a strategy that I've been using for over a decade with the S Corporation strategy. Now, it's a game changer. It's saving me hundreds of thousands of dollars in taxes over the last decade plus, and all of those tax savings I've been able to use to perpetuate and build my wealth even faster using the passive income machine. So let's take a moment to unpack the S Corporation. The S Corp isn't a type of business, but a powerful tax structure. Think of it as an extra layer that you're adding to your business, whether you're a sole proprietor, an LLC, or a corporation. When you elect S Corp status, it transforms your tax profile without changing any of your core operations within your business. It's a very simple thing to do, and it opens up an entire world of tax deductions available to you. Now, to make this a little bit more real for you, let's look at what I call the tax grid structure. It's a visual framework for bringing your tax strategy to life. So come take a look over my shoulder, and I'm going to build out this grid to reveal the S Corp's role in a tax optimized financial plan. Okay, the first thing to understand inside of this tax grid is that you actually have two tax strategies. If you're a serious wealth builder, you want to look at your tax strategy in two different parts. There is first and foremost an active income tax strategy. This is where we're going to dive into how the tax code works on your active income. For this, we want to use Robert Kiyosaki's ESBI quadrant, the E quadrant, the S quadrant, the B quadrant, and the I quadrant. Now, the second part of this tax grid strategy is your passive tax grid strategy. Now, the other part of this that most people fail to understand is they shift their tax liability to the future, meaning they're taking taxes that they would have or could have paid today as an employee, as a business owner, or as a self-employed individual, and they're shifting it to the future. They're shifting it to their retirement. Our objective with the tax strategy and using the S Corp framework is to have a framework and a strategy to lower our taxes, reduce our taxes on our active income as low as possible. Then we want to create a shield. We want to pass money from our active side over to our passive side, and as much as possible, we want to eliminate taxes on our passive income. Now, this is a visual representation of the passive income machine. I'm not gonna spend any time talking about the passive income machine, but at the very least, what we wanna do on the passive side is if you already have tax deferred assets, things like IRAs, 401ks, you want to balance out your teeter-totter. You want to have some tax deferred assets and then balance that out with tax-free assets. This is going to, as I'm gonna show you later on in this video, reduce your taxes, and it's going to allow you to retire in a lower tax bracket while actually making more money. So the critical thing to understand on piece number one is you have to have an active tax strategy and a passive tax strategy. Deferring your taxes is not a passive tax strategy. This is now the tax grid. Now, to keep things relatively simple, again, think about this on the active side and on the passive side. As we look at this on the active side, if you're a business owner or anyone that's making money outside of a W-2 income, you want to have an LLC. Now, on this LLC, this is what we're going to designate, and we're going to turn this into an S Corp, and I want you to think about it as a holding company, okay? Now, what's gonna happen here at the holding company, this is where you're going to file your tax returns. Now, I'm gonna spend a little bit more time outside of this grid walking you through what the advantages of having an S Corp are, but number one, you want to have an S Corp. For anyone that's making above $30,000 to $50,000 a year in a business, you wanna have a single S Corp. Now, below this S Corp, you might have several LLCs. All of these LLCs, we are going to have these as pass-through entities. Rather than you filing 5 returns, it's way more effective if we file one single return on your active income. So think about LLC number 1. Maybe this is a partnership, okay? On this partnership, maybe you own 50 and your partner owns 50. Your 50% is going to flow right through this LLC, right up to your holding S Corp, and we're gonna file one return and run your entire active income tax strategy out of this single entity. Maybe you have another business that you own 100%. Again, we want to separate your personal income from the actual business, and this is what the S Corp holding company is going to do. You can have as many sub-entities under here as you would like, and each one of these sub-entities will be pass-through entities, bringing all income and then all tax strategy to one single entity, your S Corp holding account. Now on the passive side, we want to do the exact same thing. We want to shift our money from our active side, and remember, the goal on the active is reduce our taxes as low as possible, and then preferably we want to eliminate as many, if not all of our taxes on the passive side. We want to take a dollar that's already been taxed once at the lowest possible tax rate and then never pay taxes on it ever again. So on the passive side, we're going to do the exact same thing. We're going to have one S Corp, one holding company that will hold all of our interest, all of our income. And then down here, we'll have as many LLCs as we need to have. Now, let's talk about this in the form of real estate. Let's say I own real estate in a state like Texas. I own several properties in Texas, and I have one LLC that houses all of my real estate in Texas. I don't file a return on this. This is all K1 pass-through income, and it all comes up to one holding account. Then I have another LLC for my properties in Tennessee. I have another LLC for my properties in Utah, and so on and so forth. I can have, again, as many LLCs as I want. All of them are pass-through entities, all coming back to one single holding company. Now, my friends, this is called the tax grid, and this right here, this is where your S Corp lives. One S Corp for active, one S Corp for passive. Okay, so now you understand the concept and the framework of the tax grid. Now we're gonna get into strategy number 2, which is starting to cut your self-employment tax using the S Corp on your active income. So let's get into the first advantage, reducing self-employment tax. Here's how it works. Imagine you're bringing in $100,000 as a sole proprietor. You've got a side hustle, you've got a business that you started, but $100,000 of total income. Let's say on this $100,000 of income, you have $25,000 in expenses, so you've got $75,000 of net income. Now, as a sole proprietor or an LLC, you'd owe self-employment tax on every dollar of that profit. That's a 15.3% hit right off the top, which adds up to over $10,000. With an S Corp though, things shift. Instead of paying self-employment tax on all $75,000, you pay yourself first and foremost a reasonable salary. Let's say $30,000. And only that salary is subject to self-employment tax. The rest flows out as a distribution, bypassing the tax burden of self-employment tax altogether. This single strategy can save you literally thousands of dollars in FICA taxes. Now, FICA taxes, if you don't know this, it's the F word for people who are trying to keep more of their money. We want to reduce our employment taxes as much as possible. So let me open up the tax code and give you a little bit more visibility of what this looks like for you as you climb the income threshold. Okay, so my friends, what you're looking at right here is a progressive tax code. This is how our active income taxes work. In this example, I gave you a $75,000 income, and without using an S Corp, you're going to be progressively taxed on all of the income that you make, both from an employment standpoint as well as from FICA taxes. Now, the interesting thing to note about this is the more money you make, the more you're going to pay in taxes. Let's double our income and say we're making $150,000 in income. Now what you'll notice is the first $19,000 that you make, you're taxed at 10%. The next $58,000 that you make, you're taxed at 12%, but now you've just jumped into the 22% bracket. And without the S Corp, you're going to pay employment taxes on every single dollar that you make, which includes FICA tax. And it gets even worse the more money you make. If we jump all the way to the $300,000 of income, now you're in the 24% bracket. And let's say you start doing really, really well in your business and you jump all the way up to $500,000. What you're gonna notice is you go all the way from the 10% bracket all the way up into the 37% bracket. The key to doing this is reduce your income with a reasonable salary. Let's say on $500,000, you pay yourself $150,000 $250,000 in salary, now what you'll notice is you're dropping all the way back to the 22% bracket, and we'll take the rest of it out as a dividend or a distribution. This changes the tax game, and it will literally, this single move, open up because of the S Corp, will literally save you thousands of dollars in taxes that would otherwise be paid that can now be redeployed either back into your business or into building real wealth. Okay, this brings me into concept number 3, which is the solo 401k. Now listen, my friends, this is going to be a very deep dive power move, and I hope you get the power of what I'm about to explain to you. Remember, when I was walking you through balancing out your tax teeter-totter, I'm gonna give you an example of doing that right here on concept number 3. Reducing self-employment tax, it's only the beginning. The S Corp opens up the door for retirement strategies like a solo 401k. Now this is a game changer for retirement planning if it's done right. Now remember, what I told you is we wanna be very, very careful about transferring our tax liability from active to passive. Every dollar that we're saving for the future is for a future stream of income. And if I'm just simply transferring all of my tax liability to the future, I'm shifting my biggest risk to when I can least afford to take it in the future. So with the solo 401k, here's what you can do. You can contribute up to $30,000 annually from your salary and match it with employer contributions through your S Corp. This allows you to both get compensated and take a deduction at the very same time. Once it's in a solo 401k, you can self-direct it and start to invest in assets like asset-backed lending, like a private pension. You can find more examples about those type of concepts down in the links below. But here's the kicker. You don't just want to defer taxes. Too many financial advisors push tax deferral as a win when it's really just postponing a tax bill. A solo 401k is only powerful if you have a tax-free income strategy to balance out your tax-deferred income in retirement. Otherwise, you're left with a higher tax in retirement. Here's a breakdown for you. If you plan to draw $250,000 in retirement and all your assets are in a tax-deferred account, you're looking at a tax bill of around $60,000. But if you balance it out with tax-free income via the passive income machine strategy, you can take the $250,000 and take $125,000 out as tax-deferred. This will drop you all the way down to the 20% bracket, meaning your tax liability on $125,000 is only $23,000, and you take the other $125,000 from your tax-free assets. My friends, this single move will give you 20% more spendable income in retirement by simply balancing out tax-deferred income with tax-free income. It is a game changer if you know how to take tax advantages on your active income and actually retire with a higher income stream and a lower tax bracket. This is how a strategic tax strategy today makes all the difference tomorrow. Remember, having a tax strategy is the single biggest indicator of your financial IQ and your long-term wealth viability. Now, my friends, this is going to bring me to concept number 4, which is family business benefits with a board of directors. One of the often overlooked S Corp strategy is the ability to involve family within your business. Large corporations, they leverage their board of directors with tax-deductible meetings. So why shouldn't you? Establishing a board of directors allows you to integrate family members, your spouse, and even your kids as trusted associates within your business, opening the doors for tax-deductible travel, meals, and business expenses. Imagine taking a quarterly board meeting at a strategic location where you plan and improve your business, the family income, while at the same time writing off your travel, your meals, your accommodation, and all of your adventures. If your children, spouse, or parents contribute meaningfully to either the planning of the business or the involvement of the business, you create a legitimate business structure that allows you to strengthen family ties while building the business. This is one of my favorite strategies that I use multiple times a year. Every single year, I take my board of directors, my family, on a vacation to plan and talk about the business and celebrate the success of being a family who runs and operates a business together. Now, my children and my spouse, they're not directly involved in the day-to-day decisions, but they are massively impacted by the effect of my business. So therefore, they're strategically involved in the planning of the business, which gives us tax advantages and an opportunity to celebrate everything that we've created together. When you start doing this, you can add things like technology costs, phones, laptops. All of this stuff can be viable tools for board members, and it all becomes tax deductible. This strategy lets you invest in your family and business simultaneously, maximizing tax savings and business impact. So if at this point in the video you're thinking to yourself, why does this matter? Let me sum it up for you. The S Corp is a powerful wealth building and tax saving structure for business owners looking to grow their wealth while protecting their income. It's about more than just tax savings today. It's about building a lasting legacy and structuring finances to thrive over the long term. Imagine reinvesting these savings year after year after year, decade after decade, compounding wealth that spans multi-generationally. My friends, this is what starts to get me excited, and if you're a serious wealth builder, I hope it gets you excited as well. The US tax system system rewards those who take calculated risks and build business structures. Leveraging these strategies isn't just an advantage, it's your birthright, your American right for being a United States citizen. Are you taking full advantage of it? Now, if you're already taking advantage of the S Corp, but I open up some new opportunities for you, drop a comment for me below. Let me know what you're doing and let me know how I can help you maximize your tax savings. My friends, all serious empire builders begin with a serious tax strategy. So if you have any questions on this tax strategy or anything else, drop a comment below, and my friends, I'll see you on the next video. Fearless.